You walk into a salon, get a haircut, pay $60, and leave. In your head, the math is simple. The stylist spends 30 minutes on your hair. The owner pockets the difference between what you paid and what it costs to wash, cut, and style it. And that's the business. Multiply that by every chair in the building, every day of the week, and you've got a tidy little cash machine. That's the version almost everyone believes. It's also almost completely wrong. The truth is that in a huge and growing share of salons in North America, the owner doesn't make money from your haircut at all. They might not even see a cut of what you paid. The person who cut your hair may not work for the salon in any legal sense. They may be an independent business owner themselves, paying the salon owner rent for the chair the same way you'd pay rent for an apartment. And that single shift, from I sell haircuts to I rent chairs, changes almost everything about how this industry actually works, who gets rich in it, who goes broke, and why some salons that look empty are thriving, while others that look packed are barely breaking even. To understand why, you have to start with the version of the business that most people still picture, the commission salon. The commission model, and why it looks better than it is. In a commission salon, stylists are employees. The owner sets prices, owns the client relationships, buys the product, pays for advertising, and in exchange, takes a cut of every service. Commonly somewhere in the range of 40 to 50% of what a stylist brings in, though the exact split varies by market and experience level. On paper, this looks like a great deal for the owner. More chairs, more stylists, more commission. It scales. Except it doesn't scale the way a factory does, because the thing being sold, a stylist's skilled labor, is capped by hours in the day and physically tied to one person standing at one station. You can't run a stylist chair overnight the way you can run a machine. You can't speed up a color treatment because you're short on cash this month. The entire revenue engine of a commission salon depends on how many hours a finite number of skilled humans are willing and able to stand at a sink and a chair, and that number has a hard ceiling. Here's the part that surprises most people. Because commission salons carry all the overhead, rent, product, marketing, payroll taxes, insurance, liability, while sharing a big chunk of the revenue with the stylist, the owner's actual margin on each haircut is often thin. Industry surveys of independent salons have repeatedly found average pre-tax profit margins sitting in the single digits, frequently below 10%, even in salons that look consistently busy from the outside. A full appointment book is not the same thing as a healthy business. It's possible to be fully booked and still lose money, because being booked tells you about demand, not about what's left after rent, wages, and product costs are paid.
That gap between looks busy and is profitable is the first crack in the popular version of this business. It's also the crack that eventually pushes owners toward a completely different model. Why rent quietly becomes the real enemy. Commercial rent for a retail-facing salon space in a decent location doesn't behave like an ordinary business expense. It's fixed. It's due whether or not a single client walks in, and in most cities, it has climbed faster over the last 2 decades than the prices salons can realistically charge for a haircut. A salon can't just move its factory to a cheaper part of town without losing the walk-in traffic and visibility that got clients in the door in the first place. Location is the product, almost as much as the haircut is. At the same time, labor costs have been rising. Skilled stylists know their value, and in a commission structure, a stylist who builds a strong personal following essentially becomes a small business inside someone else's business, bringing in loyal clients, filling the appointment book, and generating a disproportionate share of revenue. That stylist knows it too. And once a stylist realizes they're the one actually driving the client relationship, a question starts to form. Why am I giving away 40% of everything I earn to someone who mostly provides a room?
This is where the chain reaction really starts. Rising rent squeezes the owner's margin. Rising stylist expectations squeeze it further. The owner can't easily raise prices without losing price-sensitive clients to a competitor down the street. So owners start looking for a way to keep the space full without carrying all the financial risk of employing every person in it. The answer that a large part of the industry landed on wasn't a better haircut, a better loyalty program, or a fancier interior. It was a change in who technically owns the business happening in each chair. The shift from stylist to tenant. Booth rental, sometimes called chair rental, flips the entire relationship. Instead of employing stylists and taking a commission, the salon owner charges each stylist a flat weekly or monthly fee for the use of a chair, a sink, and shared amenities. The stylist keeps everything they earn beyond that fee. They set their own prices, buy their own product, build their own client list, and file taxes as an independent business, not an employee.
From the owner's side, this is a strange kind of relief. Revenue becomes predictable. It no longer depends on how many clients showed up, how skilled the stylist was that day, or whether someone called in sick. A booth renter who's terrible at retaining clients still pays the same weekly rent as a booth renter with a 6-month waiting list. The salon owner has effectively converted a service business, where income rises and falls with performance, into something closer to a real estate business, where income comes from occupancy. That's the reframing that changes how you should think about this entire industry. A salon full of booth renters isn't really a salon in the traditional sense. It's a small commercial property with beauty industry tenants, and the owner's core skill has shifted from managing stylists and client experience to managing occupancy rates, exactly like a landlord running a small office building or a self-storage facility. And once you see it that way, a lot of strange behavior in this industry stops being strange.
A quiet salon can be healthier than a loud one. This is the point where the popular understanding of the business breaks down completely. In a commission salon, an owner wants the place buzzing, every chair filled, every stylist slammed, because that activity translates directly into commission revenue. But in a booth rental salon, the owner has already been paid the moment rent clears, regardless of how busy that stylist ends up. A half-empty booth rental salon on a Tuesday afternoon can be generating the exact same income for the owner as a packed one, because the transaction that actually matters, the rent, already happened. This explains something that used to puzzle industry observers: the rapid rise of salon-suite concepts, tiny individual private rooms rather than open chairs in a shared space. The largest example, Sola Salon Studios, didn't start as a hair company at all. It began as a real estate concept for beauty professionals, opening its first dedicated building in 2004. By the middle of the 2020s, Sola had grown to more than 700 locations across the US and Canada, housing over 20,000 independent beauty and wellness professionals under one brand. Sola itself doesn't cut anyone's hair. It leases private studio spaces to independent stylists, estheticians, and nail technicians, who then run their own businesses inside walls that Sola built and owns.
The pitch to those professionals is almost identical to a landlord's pitch to a small business tenant. Keep everything you earn beyond a flat weekly rate, set your own prices, control your own hours, and stop giving away a percentage of every service to a boss. For the stylist, this can be genuinely liberating. Full autonomy, full upside, no manager taking a cut of a client relationship they personally built. For the person who owns the building or master lease, it converts a volatile, labor-dependent service business into something closer to a diversified rent roll, spread across dozens of small independent tenants instead of one anchor business. That's the surprising source of value at the center of this whole system. The money isn't concentrated in cutting hair particularly well. It's distributed across two very different economic activities happening in the same square footage: a service economy for the stylist and a real estate economy for the person who owns or master leases the space. Confusing the two is exactly why the popular mental model of salon owner is incomplete. What gets lost when the model shifts? None of this is free, though, and this is where the overlooked costs show up.
When an owner moves from commission to booth rental, they gain rent stability, but lose almost all control over the thing that actually built the salon's reputation in the first place: consistency. In a commission salon, the owner can dictate pricing, enforce a dress code, insist on a certain color line, require ongoing training, and fire someone who treats clients poorly. In a booth rental arrangement, most of that control disappears because the stylist is legally an independent operator, not an employee the owner can direct without risking a labor law problem. Tell an independent contractor exactly how to run their day, and you risk a misclassification claim, a legal finding that the contractor was functionally an employee all along, with all the back taxes, benefits, and penalties that implies. Regulators in several U.S. states have specifically scrutinized this in the beauty industry because the line between independent renter and de facto employee is often blurrier in practice than the paperwork suggests. So owners who make the shift are trading control for stability. A client who has a bad experience with one renter in the building doesn't necessarily blame that individual stylist. They blame the salon's name on the door, even though the owner may have had almost no say in how that renter worked. The brand absorbs reputational risk that the business structure no longer lets it manage.
There's a second cost that's easy to miss: retail. In a commission salon, the owner typically controls which shampoo, color, and styling products are used and sold, and retail product sales, often carrying markups far higher than services, can be a meaningful chunk of overall profit. Independent booth renters usually buy and sell whatever products they prefer, which means the owner loses that revenue stream almost entirely. The chairs might be full, the rent might be flowing in reliably, but an entire profit center that used to belong to the owner has essentially walked out the door along with the stylist's independence. This is the trade-off sitting underneath the whole shift: predictability in exchange for a shrinking piece of the actual value being created inside the building. The domino effect when the model breaks down. Here's where the chain reaction the whole industry has been navigating really shows its teeth. Imagine a commission salon owner facing rising rent and a star stylist threatening to leave for a booth rental arrangement down the street, where that stylist could keep everything above a flat weekly fee. The owner has three choices: raise commission splits in the stylist's favor and shrink their own margin further, lose the stylist and the loyal clients who follow them, or convert the whole salon to booth rental and give up control to keep the space occupied.
Many owners choose the third option, not because it's ideal, but because it's the option that keeps the lights on. Once one strong stylist leaves for a suite concept, others in the same commission salon start asking why they're still splitting revenue with an owner. That pressure compounds. A single departure can trigger a slow exodus, and an owner who doesn't adapt the business model in time can end up with an increasingly junior, increasingly unstable roster of employees, because the stylists skilled enough to build a loyal following are precisely the ones with the leverage to walk into an independent arrangement. This is the domino effect. Rising costs force a business model choice. That choice determines which stylists stay. Which stylist's departure determines the salon's remaining talent level, and that talent level determines whether the salon can keep charging premium prices at all. A salon that delays the shift too long can find itself with neither the commission revenue of the old model nor the rent stability of the new one, caught in between, losing on both fronts.
Adapting hybrid models and the rise of managed suites. The industry's response to this tension hasn't been uniform. Some owners have moved to hybrid structures, keeping a smaller commission-based team for newer, less established stylists who still benefit from mentorship, client-building support, and the owner's marketing, while offering booth or suite arrangements to established stylists who've already built their own following and no longer need that support. This lets an owner capture some of both worlds: the growth pipeline of training junior talent and the rent stability of housing established independents. Others have gone further into the real estate direction entirely, essentially becoming operators of salon-suite buildings the way Sola has, sometimes franchising that model themselves. The appeal is obvious once you see the underlying economics. A franchise-style suite operator isn't exposed to the swings of any single stylist's client base or skill level. Their income is diversified across dozens of independent tenants, much like a landlord with many units is protected from any one tenant's individual troubles. If one stylist's business struggles, the impact on the building owner is a single vacant suite, not a collapsing revenue stream tied to one person's talent.
That diversification is the quiet reason salon suite concepts have expanded so fast, especially after the disruptions of the pandemic years pushed more independent beauty professionals to want control over their own hours, pricing, and health protocols, rather than working under an employer's rules. Growth in the salon suite segment accelerated specifically in that period, according to industry reporting, as professionals who'd had their livelihoods interrupted by employer decisions during shutdowns decided they didn't want that vulnerability again. Comparing the outcomes. So, where does this leave someone actually deciding whether to open or buy a beauty salon today? In the best-case scenario, an owner who fully understands this dynamic builds a hybrid business, a base of stable, predictable rental income from established independent renters, layered with a smaller, carefully managed commission team that keeps a consistent brand experience and captures retail revenue. That owner has effectively built two income streams inside one building, a service margin and a real estate margin, and diversified against the failure of either one. In the realistic successful scenario, an owner leans mostly into booth or suite rental, accepts the loss of control over consistency in retail, and runs what is functionally a small specialized commercial property. It's less glamorous than the image of a bustling owner-curated salon, but it's stable, and stability is worth a great deal in a business with thin service margins to begin with. In the realistic negative scenario, an owner clings to the traditional commission model as costs rise, tries to compete on price to keep chairs full, and slowly bleeds margin until the business survives on the owner's own long hours behind a chair, rather than on the business itself generating a profit, which describes a large share of small, independently owned salons that never scale past a single location. And in the failure scenario, an owner delays the choice too long. Rising rent and an increasingly mobile, increasingly aware stylist workforce erode the commission base before the owner pivots, leaving a salon with high fixed costs, a thin and inexperienced remaining staff, and neither the reliable rent income of a suite model nor the strong client relationships a skilled commission team used to provide. That's the version of this business that closes.
What a beauty salon is actually selling! Go back to the haircut you paid $60 for. In the popular version of this story, you paid for 30 minutes of skilled labor and a bit of product. And the difference between that cost and your payment was the owner's profit. In the more accurate version, you may have paid an independent stylist directly, and that stylist had already paid the actual owner of the building days or weeks earlier, not for anything related to your hair, but for the right to occupy that chair regardless of whether you ever walked in. The haircut is real, the skill is real, but the business model increasingly underneath it isn't built on either one. It's built on square footage, subdivided into smaller and smaller increments, a chair, then a station, then a private suite, and re-rented to the people who actually do the skilled work, while the owner's role shifts from running a service business to managing occupancy in a very specialized, very small kind of commercial real estate. That's the real economics of owning a beauty salon. It isn't a story about scissors and color formulas. It's a story about who bears the risk of an empty chair. And the industry has spent the last 2 decades quietly moving that risk off the owner's books and onto the shoulders of the people actually holding the scissors.